Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode number 174 of the Independent Advisors Podcast, where Mark McEvely and I, Matt Jessup, bring you everything you need to know from the past week in the world of the financial markets and financial planning. This week, I have guest host Aaron Kramer with me, CFP. How are you, sir?
I am happy to be back again. I am doing well.
It's great to see you.
Yes, it's back. Glad to be back on it.
Looking good, too, by the way.
Thanks.
Encouraging people to obviously watch us on YouTube so they can see you. So before we begin, as always, I want to take a few seconds to recap the performance for the month and year for the major indices that we track, Aaron. These numbers are as of the market close on November 2nd, and this data is from stockcharts.com. The S&P 500 index month to date down 2.9%. For the year, down 21.12%. The Dow Jones Industrial Average down 1.79% for the month and down 11.53% for the year. The NASDAQ Composite Index down 4.22% for the month and down 32.73% for the year. The iShares Russell 2000 ETF that tracks the small cap index is down 3.19% month to date and down 19.43% for the year. The Vanguard All World ex-United States ETF is down 0.26% for the month and down 23.91% for the year. And then on the fixed income Treasury side, 3-month Treasury rate this morning, 4.14%. The 2-year Treasury rate, 4.7%. And the 10-year Treasury rate, 4.18%. I'll go ahead and dig into big headlines and current events, Aaron.
Absolutely. Please do.
Obviously, the market is still trying to digest the Federal Reserve announcement from yesterday.
Right.
I'll read this verbatim, and then we can have a little roundtable about it.
Sounds great.
The Federal Reserve did raise interest rates by the anticipated 75 basis points, or 0.75%. That brings short-term borrowing rates up to the range of 3.75 to 4%. The market had a positive reaction initially because they updated some wording in their press release that said, and I quote, "The Fed will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments," end quote. And then during the press conference, as Jerome Powell, who's the Federal Reserve chair, was questioned and pressed on the topic, he said that, well, of course we're going to fight inflation, and of course we're going to raise until we don't have to anymore.
Right.
And that's what really spooked the markets is, this is the first time the Fed actually added language that admitted the following. They understand that, quote, lag with which monetary policy affects economic activity and inflation, meaning they know they have to stop. It's kind of like when you have a semi-truck going at 80 miles an hour.
It's got to plan ahead.
You got to plan ahead to stop.
Right.
Right?
Yeah. I think that's interesting because kind of in the 1970s, they didn't have that understanding, and that's why inflation stuck around for so long. And kind of the flip side, I think they have to know that they can't raise too aggressively and too long because they're going to could potentially throw the U.S. into a deeper recession, right? So I think they have to kind of walk that fine line of when is it time that they stop raising rates or actually start to begin cutting rates, right?
That's right. And I think if you look at the futures market, so one way people kind of look at what is the market anticipating, it looks at interest rate futures on the CME, the Chicago Mercantile Exchange. And I think right now it's somewhere, they're thinking it will cap out somewhere around 5 to 5.25.
Okay.
Is what the futures market was indicating at least last evening. And so last evening would have been November 2nd when I went home. And you can see the Fed funds rate currently is between 3.75 and 4.
Right. So you get another percent and a half to go, right?
Yeah. And so, where I stand on this is The data on the inflation side is definitely lagging, and it's going to catch up
Right.
quicker than
Right.
people anticipate. And it's yet to be determined, if how far in advance in my semi-truck braking analogy, when are they going to begin to brake?
Right,
When are they
exactly.
going to brake? When are they going to pause? When are they going to let it coast? And I think that's the best analogy I could provide
I
with
love
this.
that. That's a great analogy.
And ultimately, in my opinion, I was watching some of the financial news stations between 2 and 4 o'clock yesterday. I was watching Bloomberg. And there's a gentleman on there, and I believe he was from Guggenheim Research, which is an institutional money manager. And he sat there and said, well, I think S&P earnings, if the way the Fed's going to continue at this trajectory, they're going to come down from $250 to $200. And I grossly disagree with that statement.
Right. Yeah.
Because what you're assuming, if you run the numbers on that, that average earnings will go down by 20%.
Right.
And this goes back to what I've been saying for the last couple of months. One of two things has to happen with stock prices, okay? Either they need to start reflecting the earnings resiliency
Yes.
of which the underlying companies have had, and at least in this last earnings season, have represented.
I have a pretty good tweet that's gonna kind of back all of what you're saying up. So continue, please.
Or, I didn't know that, by the way, or you really need to have a true deterioration in earnings.
Right. Right.
And if
Which we haven't seen.
Which we haven't seen. And then look at the job openings. I look at all my tea leaf key indicators. I'm not seeing that. And that's part of the confidence that kind of gives me that. I think that, the earnings recession that everyone's all waiting on.
Right.
Question if it's really going to happen.
I agree. I completely agree.
So anything else you want to say about the Fed? I have one more small little headline.
No. I think you summed it up pretty well.
So next week, the government reports inflation with the much anticipated Consumer Price Index report, CPI, that is due out next Thursday on November 10th.
Yep.
Let's pivot to tweets, articles, and research from the week. Aaron, I'll let you kick it off.
I will kick it off because this one goes perfectly with what you were saying.
Okay.
This is a tweet from Bespoke on November 1st, and it's a data point on corporate profits, right? So the tweet says, we're now up to 792 earnings reports this season. Beat rates remain strong at 70% for EPS, earnings per share, and 68% for sales.
Can you say that into my good ear?
You want me to reread it?
No, it's good.
Slightly more companies lowering guidance than raising, and the average stock is up 0.3% on its earnings reaction day. Decent numbers, Bespoke says. So there's a little chart that doesn't matter too much. I think the kind of their tweet there was kind of the data that I wanted to highlight. So I really think that kind of reaffirms what you just said, is that earnings reports are still holding up and corporate profits are remaining strong. And about half are still raising guidance, right? So
Yeah, and again, you're always going to have sectors in any sort of economic environment that are missing estimates, underperforming, doing financial saving tactics, layoffs,
Right.
cost cutting, etc.
well, and not every industry and not every company is going to do as well as there's a lot of competition out there too. So
Yeah,
you can't
yeah.
expect every single company to consistently meet and beat. And the ones that do, I think, should get rewarded in their share price, right?
Yeah, and I think ultimately what you've seen in a lot of names year to date is that growth rates have come in from what they expected earnings to grow year over year, but for
they're
a
still
majority,
raising,
they're still up
growing
year over year. But what does their stock price indicate?
that they would be down 20%, right?
And so it kind of makes me feel that, the classic Wall Street issue is that when everyone's anticipating kind of the same thing from happening, you tend to want to do the opposite.
Exactly.
what they're
Contrarian.
doing.
I
Yeah.
love that.
What else you got?
Yeah, I have another tweak from Bespoke.
Bring it
today.
on.
So Bespoke has had some really good info.
I love this.
So this next tweet is again on November 1st, and it's a look at the S&P sector ETF total returns since election day of 2020.
Oh.
And it says, anything stand out, ? And what listeners are going to notice on this chart is that the XLE, or the energy sector of the S&P 500, is up 236% since 2020. And pretty much everything else is mid-single to double digits, nowhere even close to that. So kind of what are your thoughts about that?
I think it's, first of all, funny how the President Biden's administration, since his election, has been the most, I think, negative and hostile towards energy in general, and it's the best performing sector. And there was a lot of reasons we could go into as to why, which kind of makes me chuckle.
Ironic.
Yeah, but on top of that, I think it just goes to show you, how much this market has corrected in roughly the last 12 months. Right. And it's had this virtual kind of this reset. And again, unless I see kind of a true erosion of earnings, which I personally don't think is the most likely outcome. Anything's possible.
Right.
It's a little bit of a head scratcher.
Yeah, and I think it also just goes to show that, I mean, obviously listeners probably know this, but energy, oil, gas is so geopolitically dependent that's kind of why it's the one outlier I would highlight as well.
Agreed.
Right?
Agreed.
Okay. I got one more article for you. It's a good one.
All right.
It's an article from Financial Advisor magazine, and it's titled "Delaying Social Security Has Rarely Been This Profitable." And this is by Alexis Leondis, if I'm pronouncing that correctly. So I just wanted to highlight a few points that she made in this article because I thought they were really, 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 really good.
Okay.
So it's she says it's no secret that delaying the start to Social Security benefits typically means you'll get more in retirement money, right? So typically each year you delay it beyond your full retirement age or beyond 62. Whenever you decide to take it, it goes up about 8% per year. So kind of the kicker with this year is even if you don't collect benefits, the cost of living adjustment that is going to be 8.7% for 2023 still gets factored into the amount you're eligible to receive starting at 62.
Boom.
So you get an 8.7% cost of living increase, and if you wait another year or 2 years or 3 years, you get 8% per year added and compounded on top of that.
That's substantial.
It's very substantial. So she goes on to say, COLA's cost of living adjustments magnify the disparity between early and late claiming.
That's the key point right there.
Yes, exactly. So just another example, in 2013, when the cost of living adjustment was 1.5%, kind of a really, really massive difference right now. And obviously, that has to do with inflation. But in my opinion, kind of going off of this article, I think it makes sense for a lot of people to consider waiting, maybe delaying it a year, if that makes sense. Again, that's not to lump everyone in the same bucket, but if you can afford to wait, having those kind of compounding 8% and 8% with the cost of living adjustment makes a lot of sense to me. And with people living longer nowadays, it typically makes sense to delay Social Security all the way until age 70, as long as your life expectancy is about 82 and a half years old. So
I agree.
Which life expectancies are getting up near that range, especially for women as well. So yeah, a really, really interesting article. I really liked it, and kind of highlights kind of the compounding factor of Social Security benefits, and all of those returns are guaranteed, right? So that's the tricky thing that you have to think about.
That's right.
Okay.
No, I love that. I'm glad you highlighted that.
Pretty good one, right? Alrighty.
You ready for me?
I'm ready.
All right, I got a couple good ones, I think, this week. So the first is a data point on where we stand with what I perceive to be supply chain issues and inflation. Okay, you ready for this, AC?
I'm ready.
So the first is a tweet by Liz Ann Saunders. She's Chief Investment Strategist at Schwab. This is from October 28th. So I'll read what the tweet says first, okay? Simply remarkable. Shipping rates on 40-foot containers from Shanghai to LA have slipped below long-term average going back to 2011, full series, putting to bed the notion that shipping rates are still elevated relative to the entire pre-pandemic era. Okay?
Wow.
Now, Jenna's going to put this chart up for our YouTube viewers. and it'll also be in all of our show notes and all of our social media on the various sites, whether it's LinkedIn, Facebook, Twitter, etc. But the reason I'm showing this is when COVID hit and all these supply chain issues were out there.
Right.
Everyone needed it yesterday.
Increase in
I
shipping
need it.
rates.
I'll pay whatever I need to. I need it. You saw these containers for a 40-foot container go up from about the 2,000 to 4,000 range. That's a conservative kind of way of saying it.
Right.
It went to above $12,000.
It quadrupled, right?
Yeah, and you're back down below the long-term average. Right now, the spot price it said on this chart, and this is again from October 28th, was $2,412 to send that 40-foot container across the Pacific.
Yeah, what's shocking to me is that it's below the long-term average rates, even as inflation has remained high, and those kinks in the supply chain worked themselves out pretty quickly, didn't they?
That's the point right there.
Yes.
That's the point, right? And so think about that. Think about the supply chains.
Well, I just remember hearing on the news headlines all those ships just sitting out waiting to get unloaded outside of LA.
ships outside Long Beach. Remember that?
I do. And
so just kind of an update that supply chains are normalizing, I think, a lot quicker than
people
the
anticipate.
scare headlines have indicated.
Right.
I know that I remember on the podcast we were talking about all the magazine covers, right? Were
Right.
exactly what you're saying. There are pictures of all these container ships.
Just parked
this is
out
going to
there,
take
right?
years to normalize. I'm not saying there's still not kinks in the system, but this is definitely a very interesting data point.
It's interesting how quickly they've fallen as well.
Yes. All right, my next thing, and I talk about this in the peaks and troughs when it comes to optimism or bearishness in the market. My next piece is a highlight of how much bearishness, Aaron, is really out there.
This is really interesting. I like this.
Okay, and this is a tweet from Helena Meister, and I'm probably pronouncing her name wrong. You want to give a stab at it?
I think it's Helene Meisler.
Meisler.
I don't know.
Okay. So she is great because she has a lot of content, and she's a writer for Real Money. Okay.
Great.
So the first thing is a chart that says, quote, this is kind of interesting. In the 2007-2009 bear market, we had plenty of times where the bull-bear ratio was positive. Now, what that's indicating is that people who were bullish outnumbered the number of people who were bearish.
Right.
Got it? We've only had exactly 1 week with a positive ratio since the year of 2022 started, Aaron.
Wow.
Now, it's accompanied with the chart that reflects this, and it shows you how many more bearishness there is out there than there is bulls, and this comes from the AAII, which is a individual investor survey. And the thing I like about this is the data sets go back decades.
Yes. Yeah.
Okay, decades.
So this chart goes all the way back to 2002, right?
This one specifically does. And so, excuse me, with that being said, it makes me have this viewpoint. If everyone is so bearish, okay, you've already, for the most part, allocated your portfolios to reflect that stance.
Right.
Okay.
Gotten more conservative, most
Gotten
likely.
more conservative. You've raised cash, et cetera, et cetera. And the last time I was on the podcast recently, I highlighted the percentage of cash that the average mutual fund has in comparison to history, which is also at a multi-decade high. The point I guess I'm trying to make is you're now seeing so many people that are, quote unquote, in my opinion, on the sidelines, relatively speaking. Everyone's kind of looking around in the room and saying, okay,
Who's going to make the first move?
Who's going to make the first move? I'll wait. And then we're all going to pile in.
And then a lot of those people are going to miss it, right?
And a lot will. And what's going to happen is, whether it's a week from now, whether it's a month from now, whether it's 6 months from now, whether it's a year from now,
that money's going to start
when
flowing
money
somewhere.
starts to flow in, and I'm not saying it's going to be next week.
Right.
Okay. But I want to remind people, this is not a market that I would recommend having any relatively high degree of confidence that you can time.
No,
Because
absolutely
this
not.
is going
No
to be
market, really?
yeah,
Right.
but especially right now. I mean, the spring has been compressed, and you just don't know when that sucker is going to get released.
Right.
And all it takes is one comment from the Federal Reserve president in 3 weeks.
Yep.
It takes the
The
Federal
midterm
Reserve
elections,
minutes.
right?
This is just an environment where, corporate profitability has been so resilient, and you're seeing the bearishness just so high that I'm going to argue at a certain point here, the risk to a rip-your-face rally to the upside compared to another dramatic downleg, that's something that you really need to think long and hard about.
Yeah, I mean, I completely agree with you. In my opinion, there's several catalysts out there that could cause the market to rip, right? And kind of my opinion is the midterms, corporate profits, right? Earnings season had, I want to say the Dow had its best month in October since 1976, right? Mm-hmm. So there's in my opinion a lot of potential catalysts out there that could cause the market to rip, and trying to time that is nearly impossible.
That's my
right?
words of wisdom.
Right.
That's my words of wisdom. And then the next one I have, and this is my last one before I'll turn it back over to you for the financial planning topic of the week, Aaron.
Perfect.
I got some bespoke raw data.
Again.
I like the raw data because
too.
you can't spin that. The
That's right.
data is what it is.
It allows you to form your own opinion on
That's
it,
right. You can interpret the data the way you want, but the data is what it is.
Exactly.
Okay? So this data from Bespoke, Aaron, is from October 31st. Okay? It's going to be the 4-year presidential cycle going back to 1928. Okay?
It's a lot of data.
Yes. So if you look at this, and I'm now going to quote Bespoke for a second, the 4-year presidential cycle going back to 1928 is also turning from a headwind to a tailwind for stocks. Historically, year 2 of the presidential cycle, this year, has been the worst for the S&P of the 4-year cycle going back to 1928, while year 3, which would be next year, 2023, has been the best. Mm-hmm. Year 2 of the election cycle has seen the S&P gain just 56.5% of the time. But year 3 has seen the S&P gain 82.6% of the time. Next, Jenna, for our YouTube viewers, is going to put up a chart from Bespoke that shows the S&P 500 throughout the 4-year presidential election cycle, with the index's performance during President Biden's term so far overlaid. Again, while the magnitude of the move in the current cycle is much larger than average, the patterns are
very
dissimilar. So next, what I want to highlight, and again, this is a really good chart I would encourage our traditional podcast listeners to go to our show notes and see. Because what you're going to look at is the year 3 definitely tends to be the best performing year of the 4-year cycle. On average, in year 3, the S&P 500, going back to 1928, has gained 13.51%. On average, that specific year 3 of the 4-year cycle, Aaron. That's very telling.
It is very telling. It's doubling or more than doubling the other
three year
years,
1,
right?
2, and 4. Yeah.
Right.
Yeah. And so again, my message for viewers and listeners is it's been a long year.
Absolutely.
Okay? It's been a long year. It's been a tough market. It's like water torture. It's a constant drip, and I get it. And the thing that I like to just kind of remind people is until I start to see a large erosion in corporate earnings that would justify these lower prices, I'm going to remain optimistic. My personal opinion. And in addition, I just think that with the amount of bearishness that is out there, the amount of cash that's on the sidelines, my words of wisdom is this is not a timeable market. Now, it never is, but this is like one of those where you could literally,
really not, right?
on different pieces of news, you could literally have just as much as you could have down days. You could have a 6, 7, 8, even more single up day on any specific potential catalyst.
Yeah.
Be careful out there. This is not a timeable market. It's time in the market.
Absolutely.
In my opinion, that drives success. We've talked many times about missing out on the various number of positive up days.
Yeah, if you miss a couple,
of the biggest up days in a calendar year.
You can miss out on 10, 15%, right?
You could. So just be careful out there. This is a time, this is an environment where you continue to invest for your risk tolerance for the long term.
Absolutely.
All right, I'll turn it back over to you.
Awesome. Well, just last piece is the financial planning topic of the week. I've got another article here. It's from Vetify, or Advisor Perspectives, is the website, and it's going to be about 529 contribution limits for 2022 and 2023.
Okay.
So this article is by Javier Simon, and it's from actually September 28th. So let me get this teed up real quick, and I just wanted to, again, highlight a couple of the points that Javier is making. I don't want to read the whole article.
Great.
So contribution limits range by state, so it is state to state dependent. So there's maximums not really per year that you can put in. There's really no maximum. The only thing to be mindful of is going to be the lifetime gift exclusion, right? So I wanted to highlight kind of the maximums and just give some listeners a couple ideas on how you can utilize these 529s, whether it's grandparents, parents, all of that good stuff.
Great.
So the plans range from $235,000 that you can have in the 529 plan all the way up to $550,000 per plan or per beneficiary, right? So typically 529s are going to be owned by a parent or a grandparent of the potential college student, right? So you can have as many 529s the parent could open depending on how many kids they want to have as beneficiaries.
Okay.
But again, those limits are going to drastically vary by state, 235 all the way up to 550,000. Okay. So again, with inflation being higher this year, the annual gift tax exclusion is going up. So theoretically, people can gift $16,000 now per year per beneficiary and not have to file a gift tax form, right? So
Correct.
One interesting thing that is maybe for people that do have a lot of college savings that they want to put into a 529 for a child or a grandchild is you can contribute $80,000 per year in 1 year now because there's a 5-year rule.
Yes. To where it allows you to kind of do it up front, but play it over the 5 years.
Exactly. So that's what I wanted to highlight is that amount went up from, I guess, about $75,000 now to $80,000. So that's a really big chunk of change that you could throw towards a college fund and allow that money to grow tax-free, right?
Kind of front load it a little bit.
Front load it, allow it to grow a little bit faster. Typically,
not a bad time with where the market is, relatively speaking.
Exactly. So I think if you do have the cash that they're wanting to contribute to your child or grandchild's college fund, I would say maybe now's a great time to do it, especially with the limits going up. So again, there's different benefits by state. Some 529 plans are going to have tax deductions or tax breaks.
Sure.
But it's really going to be dependent on the state. So it gets a little bit confusing because some states are very generous and some states are not at all. So it's something that you have to be mindful of which state you're in. And interestingly, there's also some 529 plans that the investments, in my opinion, are better in certain states.
That's a good point. That's a good point.
So I would say if listeners are thinking about opening a 529 plan, I would shop it around depending on which state, especially if your state doesn't offer any tax benefits. It might make sense to go to another neighboring state or say Virginia 529 versus Kentucky 529, right? So there's, I would just shop it around and kind of do some research on which 529 plan might be the best from the investment standpoint. because some are going to have just kind of basic target date funds, and some might have a bigger kind of range of investment options.
I love that.
Right?
So I love that. Yeah.
Yeah. Just kind of was thinking about. I think I had a client ask about 529s recently. Just kind of prompted my thinking on what's going on with them. Right.
I love that, Aaron. I love that.
Any other thoughts you have? Anything on your mind?
Nope. Next week, Mark and I will be recording the podcast. We're going to be at an investment conference. You'll be with us, my friend.
Absolutely.
We're going to be out in San Diego. There is a conference that we're going to be at, and Mark and I are going to tape earlier in the week. We're going to do it by Zoom, and I know Jenna will work her tail off to piece that together and have the content for our viewers and listeners next week. So as always, Jenna, we appreciate your hard work. And so Mark and I will record that remotely. And I know you and I and Mark and Nick and Taylor, we're all looking forward to the conference. And
yeah, it's going to be a great conference.
Yeah, I mean,
fortunately, I get to knock out a lot of my continuing education. So
there you
it's
go.
Going to be a lot of fun.
There you go. And again, this is a reminder. Aaron does have his CFP, his Certified Financial Planner certification, and that also comes with a lot of responsibility.
It does.
So you'll be busy.
Never not learning, right?
Never not learning. You'll be busy with those sides, and it'd be good to network with peers in our industry and kind of see what others are thinking.
Yeah, I'm really excited to see some of the kind of growing technology in the industry, and always the ever ongoing compliance and regulations that we get to learn about, right? So,
oh yeah, we're a very regulated industry, and a lot of those regulations are there for good reasons,
Absolutely.
and we have to make sure we adhere to them. And again, I just want to end it with this. I think, it's been a long year, it's been a tough year. Mm-hmm. This will pass. The underlying resiliency of corporate earnings over the last many decades has been tremendous. And, these are times where people tend to let emotions guide decisions. And I would just invest for the long term.
Absolutely. Love that.
All right, everyone, take care. Thank you for listening to episode number 174 of the Independent Advisors Podcast. Aaron and I appreciate you guys listening, and Mark and I will see you next week.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved. Advisory services offered through Commonwealth Financial Network, a registered investment advisor.